Welcome to Allianz Global Investors webinar series. Today's topic is income and growth and selection income and growth. My name is Charles Ma, and I am your host for this afternoon. Since the beginning of the year, market volatility has heightened across the world. And today we are happy to have Karen, our specialist of income and growth team, to give us an update on the two funds and the US market. Karen has been part of the income and growth team for over 6 years. She is based in Hong Kong, but is also responsible for our Southeast Asian market. On that note, Karen, the floor is yours.
Right. Thank you. Thank you, Charles. Thank you for the kind introduction. And welcome, everyone. First of all, on behalf of the Income and Growth team, I would like to wish everyone a very happy, healthy, and prosperous new year. So today I'm going to spend the next half an hour or so on sharing with you some of the views that we have on our income and growth strategies. So just a quick reminder that for our regular income and growth fund, which is 1/3 US high yield, 1/3 converts and 1/3 equities, we also have a selection income and growth, which focus on the higher credit quality bucket of the corporate universe. And hence, that strategy have 1/3. Instead of high yield, it consists of investment grade US corporate. So let me quickly jump to the next slide. So just a very quick recap on what had happened in 2021. On the left-hand side of the chart, well, you could see here many of the risky asset classes, as particularly stock. The stock indices have returned double digits in 2021, be it in growth or in value or even in small cap. And as for converts and high yield, as well as the U.S. Investment grade corporate converts and high yield deliver a mid-single digit return, and whereas the higher credit quality, because of the rising rates concern, actually have returned flat to slightly negative for the entire year 2021. And very quickly, moving on to the right part of the chart, we can see that the January return of this year. Well, market started off the year with a very aggressive correction in January. And as you could see, many of the growth-oriented names have suffered quite a bit in the beginning of January. And the sell-off has started to broaden out to value names as well, and eventually has impacted the entire market in general. As the market's starting to focus on the rate hike, fear that the Fed is going to move more aggressively, the persistent high inflation, and also some of the uncertainty related to the Omicron cases actually back in Q4 last year, and how it would have impact corporate earnings growth, and some of the geopolitical risks in the beginning of the year have formed a very cloudy and uncertain situation for the market, and hence affected market sentiment tremendously. I just want everyone to remember and bear in mind that actually stock market correction of the magnitude of around 10 to 15% is actually very common in any given year, in a very normal market environment as well. And a correction, it could even be higher for some of the growth name. So it's actually very important for us to take a step back and to think about where we are in the economic cycle. What is earnings growth going to be look like coming into 22, and how one should position their portfolio to navigate this kind of uncertain environment. I think that when we look at the U.S. markets for this year, it's fair to say that, well, no one is really expected a recession. But in fact, when we look at the macro backdrop of the U.S., economic expansion is expected to continue in 22, and so is earnings growth. But of course, the magnitude of this growth is going to be more moderate coming into this year. So what we are expecting, and in a very reasonable way, that the GDP growth of the US as well as earnings growth of US corporations should start to converge to the trend growth coming into this year. Moving on to the next slide here, you could see that income and growth actually could be a very familiar chart for everyone here. Well, income and growth actually remains a all-weather solution for income-seeking investors, as well as those looking for the potential growth in the U.S. market. Again, quick reminder that the strategy itself is focused on a static allocation into one-third U.S. equity with a tactical cover call option, one-third convert, and one-third corporate bonds. So again, the regular income and growth fund will have high yield exposure in it, and whereas the selection income and growth would have investment grade corporate in it. The investment team, again, their expertise is not timing the market. So how the Fed going to move, how fast the Fed going to move actually is not their concern. But what they're focused on mainly continue to be focusing on selecting companies that will continue to grow in this kind of market environment. And more importantly is to identify the most optimal capital structure that they would want to have exposure in, and in turn return to have the best total return experience for investors. But more importantly, the focus should be around how this multi-asset solution could help investors achieve their return, their long-term return objective, and more importantly, in this kind of volatile environment, the asymmetric nature of these three asset classes in aggregate could provide the downside buffer when the market goes down, and to allow investors to participate in the potential growth of the U.S. market when the market starts to trend higher. So on to the next slide there. Moving on to the next slide here, well, you could see that the risk-reward profile of the various different asset classes, it's quite straightforward for a stock exposure. So you could see that for Russell 1000 and Growth Index, one should expect to have a 100% participation on the upside as well as on the downside. But for converts and high yield is actually a little bit different. Adding converts into the broad strategy actually could help buffer the downside because convertible bonds does provide a good buffer. The bond floor of these bonds could help mitigate some of the downside risk when the market goes down, and hence one should expect that convert exposure will continue to deliver an equity-like return, but yet with a lower volatility than a pure equity asset class. And similarly for U.S. high yield, over the long term, because of the attractiveness of the higher coupon income, of course, staying in corporate bonds, you will have limited upside. However, high yield does provide an attractive coupon income and a lower volatility as well. And as for our selection income and growth strategy, what our target and focus is actually in the intermediate part of the investment grade corporate bond universe. This will help mitigate some of the interest rate risk exposure. But again, we are not trying to make a call or to time the market, and hence we do not actively hedge or position the sleeve to capture any kind of interest rate movement, but in turn, again, to focus on selecting the right credit and deliver the return to investors. So on this slide here, you could see that the correlation of these asset classes with respect to different asset classes as well. So for the U.S. convertible bonds, you could see that the correlation to stocks is actually higher compared to interest rate sensitive instruments such as the U.S. government credit bond index, as well as the 10-year treasury. Correlation there is actually very low to slightly negative. And as for high yield as well, high yield correlation and sensitivity to stocks is actually higher. And for those who's actually looking and worried about the rising interest rate environment, could consider having high yield as their exposure to mitigate some of these interest rate risk. So not surprisingly, the last asset class is there, the intermediate U.S. investment grade corporate bond index, will have lower correlation to the U.S. equity market, but have a higher correlation to interest rate and duration exposure. So for investors, it all depends on what you're looking for. So investors looking for a more diversified kind of solution, selection income and growth does offer a lower volatility in the long term, but of course, it comes at a price as well, because the income that you will earn staying in the high credit quality part of the investment grade corporate bond index will you will have to give up some of the income over time as well. One of the most topical thing this year, of course, is rising rates, as the Fed starting to hike rates coming in March. I think this is a foregone conclusion. Market is now pricing in at around 5 to 6 hikes in 22. So observing and looking at how the income and growth asset classes perform in different kind of interest rate environment, you could see on this chart here on the left hand side is falling interest rate environment is pretty straightforward. Many of the asset classes actually do pretty well. But our focus is actually on the right-hand side of this slide here. Under a rising interest rate environment, actually, for stocks and converts, actually, they do quite well as high yield as well. Reason being that we are now in an economic environment where growth is robust. The inflation is higher than what the Fed would want it to be, but more importantly, for the Fed to fulfill its dual mandate, having a maximum employment as well as a stability in price level, it actually makes sense for them to move rates higher. And as long as earnings growth continue and U.S. corporation continue to grow their earnings, grow their margins and profitability in this kind of macro environment, in a rising rate environment, as you could see, history has shown that risky asset classes could actually do well in a rising rate environment. And whereas for the longer duration interest rate sensitive asset classes, one should expect it to suffer a negative return in this environment as well. So in particularly for the investment grade corporate universe, of course, the duration of higher credit quality bonds are higher, and hence its exposure to interest rate is also high as well. But for selection income and growth, our target is actually the intermediate part of the investment grade corporate bond universe, the 1 to 10 year bonds. So what we're trying to do is to balance the interest rate risk to have a attractive income, but yet not have a very high exposure to interest rate risk, but yet still be able to deliver an attractive return. So you could see on this chart here, actually over the last 25 years, investment grade corporate bond universe rarely produced a negative annual return. And even in the previous hike cycle, in the 2015 to 2018, you could see that the market does deliver a positive return as well. One of the value proposition of staying in selection, income and growth, and have exposure in the investment grade corporate bond universe is that you could see that the credit risk for investment grade corporate bond is actually quite low. You can see that the default risk is actually very, very limited. And even during the global financial crisis in 08, 09, during the dot-com bubble burst in the 2000, you could see that the default risk of investment grade corporate bond is extremely low. So you would get compensated for the risk that you are taking, of course, if you decided to have exposure in high yield. The default situation in the high yield market definitely fluctuates more, as you could see on this chart. The blue line there is the trailing 12-month default rate of the high yield market. But one thing to note, at the moment, you could see that the default rate of the high yield market is actually very low as well. We are now to the sub 1% default rate level. What we're seeing going forward into this year is that we continue to see good credit fundamentals in the corporate bond market, be it in investment grade bond or in high yield bond. especially in high yield, looking at where spread is, which is at around 350 basis point over Treasury at the low end of its historical range. The high yield asset class is not exhibiting any signs of stress, and especially with the primary market remain open and corporation could continue to access the capital and liquidity of the corporate of the high yield market. These are some of the conditions that we see will continue to support high yield market going forward. But more importantly is actually the credit fundamentals of the high yield market remains to be very sound for the year 2021. And this trend is expected to be continued into this year, is that we continue to see more more upgrades versus downgrades within the high yield market as well. So given what we have seen in the credit bond market, this also gives us confidence in some of the bond floors that we're seeing in the convertible bond security market as well. Because given the recent market correction, what we're seeing in the convertible bond market is that more than one third of the convertible bond market universe are now trading at actually around 80 to 90 cents on the dollar. So they're trading below par. What this means actually is that the risk reward profile of having convertible bond in your portfolio is actually attractive, because many of these names are actually trading at near their bond floors, and hence with a lot of support on the downside. So going forward, if equity volatility continue and persist, one should expect that convert should exhibit good downside protection. And if the contrary happen, when equity market starts to trend higher, we should also expect convertible bonds to participate many of these upside going forward. And especially for this year in 2022, many of the market strategists are expecting the new issuance in the convertible bond market to continue to grow. The consensus is for new issuance to be delivering at around 60 to 65 billion of new issues in the year 22. As you could see on this chart, it's a slower pace compared to 21 and 20, but still it's well above what we have seen in the previous years in before 2019. So new issuance coming into the market, robust activity into the convertible bond market is actually positive for income and growth because it will help broaden out the investment opportunities, but at the same time will allow the rotation into balanced convertibles to happen for income and growth, and to ensure that we have good downside protection and a more balanced exposure in the convertible bond sleeve as well. And a couple of the key ingredients for equities to continue to do well, again, the most important thing, of course, is earnings growth. And on the right-hand side of this slide, well, you could see how earnings growth continue to trend higher over time. Again, I would say that 22 is a year of normalization. So one should not expect to have the kind of earnings growth of 40, 50% like we have seen since COVID, since last year. But one should expect earnings growth to converge to a more trend growth pace, a mid to high single digit as well. So right now, in the middle of the Q4 earnings season, what we are seeing actually is continue to see some of the companies exceed earning estimates, but the overall sentiment is actually more balanced. And as for the income and growth team, we continue to monitor some of the name selections that we have. And at the same time, the macro environment of the US, as you could see on the left-hand side of the chart, GDP growth, again, one should expect growth to normalize coming into this year. It's not going to grow as quickly as we have seen in the past few quarters, but yet You could see on this chart, estimates continue to remain at around 3 to 4% and slowly trend down to a more trend growth type of environment of around 2 to 2.5%. So from the investment team a point of view, given where growth is and given where earnings growth expectation is, they do expect that equities could return mid to a high single digit for the year 2022. And lastly, of course, the market doesn't move in a straight line. We all know that the volatility that happened in January in the beginning of this year did lead to market volatility. S&P 500 is down 5% in the month of January, but intra-month it had a drawdown of around 12% intra-month. So volatility is high. As you could see that there will be moments of volatility spike that will happen in the market at any given point in time. For income and growth, one of the tactical strategy that we have within the equity sleeve is our cover call option strategy. So depending on where volatility and opportunities are, the investment team does underwrite cover call option to help supplement income and to help mitigate some of the downside volatility as well. So for income and growth, the three asset classes can provide investors with a source of income and at the same time to allow them to participate in the market potential upside. So for investors coming into 2022, think of what the market environment is. So we're still in a market environment where rate is low. The market is fear of higher rates, Fed moving quicker than expected. There will be volatility coming from the equity market as well as the fixed income market as well. Rising inflation could be a threat to erode some of the wealth that you have. So for investors, it will actually income and growth will make sense for them because it could help investors capture some of the income in the market through the three underlying asset classes, through the multiple sources of income that we're trying to capture and deliver that to investors. And at the same time, will allow investors to participate on the potential capital appreciation that have a equity volatility that is lower than a pure equity strategy and a lower correlation to rate sensitive fixed income instrument.
Allianz Global Investors.